to if you have a well-run and established existing platform business, i.e. your agency is capable of adding on agencies, I think it's totally fine and feasible to go look at doing smaller deals and adding them on. I think if you're saying, hey, let's say I just sold my agency and I want to get into a new business, don't go buy a business that's making a couple $100,000. Go buy a business that's making more than that.
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. Today, I'm joined by, I don't know how to describe this person. This list of, I was telling him before we started that I can't read this bio because there's way too many accolades on here. Forbes top 30 under 30, has built, exited, acquired multiple businesses, has been in the M&A space for a very long time, despite being a pretty young person. And so I'm really excited to have Matt Bodnar here today to talk to us really about the last 10 years that he's spent in mergers and acquisitions, acquiring and purchasing majority ownership in a lot of companies. So it's a mixture of having a viewpoint in M&A, but also being in the weeds, growing and scaling these businesses, almost like micro private equity, but I guess we just call it a family office, don't we? So with that, Matt Bodnar, thanks for being here today.
Marcel, thank you so much for having me on here and appreciate the intro. Yeah, I mean, candidly, it's a word that's kind of loaded, but I refer to myself as a private equity investor, for lack of a better term, though not a big institutional New York private equity investor, right? So I'm based in Nashville. I look at small to medium-sized businesses and I like to invest in them, acquire them, scale them. In some cases, sell them. A lot of cases, we also have an orientation towards longer term buy and hold. That doesn't fit every market, every strategy, but that's generally our ethos. I worked at Goldman Sachs up in New York for a number of years. Came back to Nashville in 2011 and really bought my first business, which was an IT service company. Operated that business myself for about 6 years. We did a couple add-on acquisitions into that business. Eventually fired myself as president, CEO of that company. Brought in an operator and started really building a portfolio of operating companies from there. So today we still have that business, have a software company, a manufacturing business, a distribution company, a staffing firm, a beauty products brand, just recently sold a medical equipment company that we had, and a couple other investments in a few random crazy things ranging from ski resorts to all kinds of other stuff. So very eclectic mix of things, but really at the end of the day, I'm just looking for interesting companies and ways to add value. And I think my fundamental belief is that mergers and acquisitions, or a fancy way of saying just buying businesses, is not only a great way to generate value generally, but I also think it's a really compelling growth strategy that a lot of businesses don't fully utilize or don't understand.
Yeah. And that is the topic for today, is really talking about M&A as a growth channel, in particular for our audience, which is mostly agencies. And so you spent some time working inside of service-based businesses, like you worked as an analyst and you worked at Goldman, and then you owned an IT services company. I know that you've spent a lot of time in other variations of service-based businesses since then. The first question is, when did you wake up to this idea of mergers and acquisitions and realize that it was something that you wanted to get more focused on?
Embarrassingly late in my life, honestly. And by that, I mean, I was doing it for a while without ever really realizing what the potential of it was. And by that, I mean, when I came back, I'm from Nashville. So when I came back to Nashville from being in New York, I bumbled my way into basically finding this IT business, doing about $1 million of top line revenue, barely could make payroll, breaking even, kind of struggling company, right? And I basically came to them and we just sort of sat down at the table and I was like, look, I think maybe I can help you guys out with this thing. I don't really know, but if you're willing to give me some equity in this, let's figure it out and we'll sort of do a deal. Ended up getting effectively what you would now call sort of a seller financed buy into the company that started at about 40%. I ended up ultimately owning about 65% of the business, never having put a dime into it other than the company basically paying my way into the business, and ran that company for 6 years. We ended up fixing the original business they were in, which you being a wizard at this stuff would have probably loved some of the early conversations that we were having. And candidly, a lot of it was just the difference between collecting receivables versus booking revenue, and they really struggled to get their ARs collected. And I became just an AR collecting assassin for about 8 months of my life, just hammering on people to collect bills. But I learned a really important lesson that any business owner will eventually learn, which is cash is king, right? And so did that for a while. We did, and then stumbled into a couple add-on acquisitions that just kind of fell in our lap. And really, it wasn't until I kind of started understanding this concept of both using creative deal structures, which we can give you myriad examples of, but using creative deal structures. And also, there's a model out there called the independent sponsor model, which is basically finding a transaction, raising the capital for that on a deal by deal basis instead of having a big fund. I told myself when I was younger that, hey, one day when I grow up and I've got, I have either this war chest of tens of millions of dollars, or I go raise $100 million plus fund. At that point in my life, I can go do private equity, right? And what I realized was, given all of the tools and resources today and understanding how to approach more creative deal structure, I could just start doing deals now, basically, right? And that dawned on me kind of 2016, 2017, when I stepped out of day-to-day management of the first company that I'd purchased. And I was like, wow, this is awesome. So then I started buying other businesses and looking for opportunities and doing deals. And to me, the toolkit, the combination of really creative deal structure, which is a huge piece of the puzzle, and also understanding and learning how to raise capital. And you don't need to raise capital for every transaction. I think that's, especially if you have an existing business, you can do a lot of really cool deals without having to raise any capital at all. But understanding the skill set of raising capital is a really critical point if you want to start doing bigger deals and you want to start doing what's called a platform, sort of new acquisitions in new sectors and industries. It's a great skill set to have. So I kind of stumbled into starting to learn some of those things, and then eventually dawned on me that I could really do it now. I just needed to do it a little bit differently than I thought I had to do it.
Mm. So taking a step back to that IT services company, that would have been your first exposure to, hey, we can purchase other businesses and roll them into this. What did some of those early deals look like, and how did that impact the business, to the degree that you wanted to do more of them? Because I think a lot of people, maybe they have trouble with the integration, or they don't strike the right deal structure, and so they might actually get jaded from that first deal. But in your case, it seems like it's something that went well enough that the next time you had an opportunity, you decided to do it again.
Yeah. So similarly, we did a couple early deals that really, for lack of a better term, fell in our lap. We weren't being intentional about sourcing deals, though you can intentionally source opportunities like this. But one of the early deals we did was what I call a business giveaway, which was basically this guy who was in our market came to us, and he had two different businesses. One of them was a data center that was doing $300,000 or $400,000 a year of top line revenue, and not a huge company, right? Relatively small. Our business at the time was doing a couple $1,000,000 of revenue. So, I mean, it was maybe 10, 20% of revenue, whatever. Again, not huge, but not insignificant. And he basically came to us and said, hey guys, I have this other business that's going super well. This data center is a distraction for me, and I'm thinking about closing it. Do you guys want to buy it? Right. And we said, maybe. Right. And so we kind of looked at it and we're like, look, we're interested, but we're not going to come and give you like 300 or 400 grand for this thing, right? Like, what we'll do instead is we're willing to pay you a percentage of revenue over a couple years that come out of this business unit and the customers that we take over. And we'll pay you that, and in exchange, we'll take this headache off your hands. And instead of shutting it down, you can now monetize that revenue stream and find a home for those customers, and you don't have to worry about the headaches of dealing with this business unit, and you can focus on the other business unit in your company that's doing much better. So I wasn't setting out to be like, hey, I'm going to go do some zero out of pocket acquisitions and use these fancy strategies. It was just, we kind of bumbled into that one, to be honest. But then we were like, hey, that was pretty interesting, right? And so that deal taught us that we ended up buying like a $400,000 a year revenue stream that not only was profitable for us day one, even after the rev share payments to the seller, but also we had the opportunity to cross sell that business into our business and cross-sell our business, which was more vanilla IT services, phones and networks and that kind of stuff, into the other customers from the data center business, the co-location hosting business. So what happened was we started to see some of these green shoots and synergies that can come out of doing acquisitions. And if you have an agency, I know obviously most of the people listening to this are agency owners. If you own an agency and you're doing a couple $1 million of revenue, there's an insane amount of sole proprietor agencies out there that are either literally a single person or maybe two or three people doing 300, 400, 500 grand of revenue. And I can give you a couple specific case studies of people that I've encountered in the last 6 months that are exactly like that in the agency vertical. But there's tons of people like that are either burnt out, frustrated, and in some cases they may want to do a business giveaway deal like the one we did with the data center, where they just say, "Hey, I want to home." I met this woman who owns a small agency. She's doing about 300 grand of revenue. I talked to her probably 4 or 5 months ago at this point. And I do a lot of cold outreach for acquisitions, right? And I happened to meet her through some of my cold outreach. Talk to her, and she's like, "Look, I've had this agency for a decade. I'm very loyal. I'm not going to let my clients down, and I'm not just going to close it down and leave them stranded. What I really want is to find a place, a home for my clients, so that they can have someone who's going to take care of them. If I find a way, maybe they pay me a little something to kind of, make it worth my while, great. But I really want to go do this other business," right? I think she had I forget exactly what her degree was in, but she had some other project she was like really passionate about that she wanted to do instead. And so that's a perfect instance of an opportunity where you can say, "Hey, this person wants to get out of the business. They don't want to leave their clients behind. And it's somebody with the right mindset could pick that business up for $0 out of pocket, add a couple hundred grand of revenue, and there's opportunities." So, I forget exactly what business she was in, but let's say she focuses, I think she mostly did web dev, right? So it's like she's doing web dev. It's like, okay, well, if you're mostly doing SEO, you can cross sell that into all of your people. And maybe there's some of your clients, if you're not doing web dev, that you can take some of the skill sets or expertise from her business or processes or vendor relationships or whatever, plug them in and add some web dev to your company. So there's tons of opportunities out there to do deals like this. And I know I'm kind of jumping ahead, but I really like agencies as a space in particular for a lot of these reasons, because it's a highly fragmented space, almost by the nature of agencies to some extent, but it's highly fragmented. There's a huge amount of sole proprietors, and there's a ton of opportunity for sophisticated, and you don't have to be doing $50 million a year of revenue. If you're doing 7 figures or more of revenue, there's a real opportunity for you in the agency space to go and do if you do one deal like that a year, right? You go from, let's say you're doing $1 million of revenue, you buy somebody doing 300K, right? That's 30% growth for no capital invested. You take over their business as a rev share. So the downside is very mitigated. You don't have any organic growth at all. The next year you do the same deal. Now you're at $1.6 million. The next year you do the same deal. You're at $1.9 million, right? So in 3 years, you've doubled with no capital investment, not counting the opportunity to cross sell your products into those people or cross sell either way, right? So there's lots of synergies and opportunity there. So long-winded answer to your question, Marcel, but that's how what we sort of learned from some of those early case studies. And there's a lot of lessons there that I see for especially existing agency owners to apply these strategies very creatively to do tons of deals without having to go raise money from investors or take out an SBA loan or whatever. And those are valid strategies too. I wouldn't rule them out because they may work really well for some deals, but you don't have to have those things to do really interesting deals.
100%. And the other dynamic that we haven't even talked about, but compounds all of this, is this very real kind of roll up, if you will, dynamic, which exists in agencies just like any other business model, where let's say you take that $1 million business and you turn it into a $3 million business in 5 years, and the EBITDA goes up. And assuming you have some economies of scale, you start to dial in, you're pretty good at operations. Maybe you hire Parakeeto, we get your profitability dialed in. That EBITDA multiple starts to go up. And, I remember I had my cousin was working on a roll-up deal in the pharmacy space. And it's like they would buy pharmacies at 3x because it was one pharmacy. And as soon as they bought it, because they had like 100 pharmacies that they're rolling that into, the multiple went from 3 to 6 before they did anything else. Plus they were buying all the products at discounted prices because they had more buying power. They had unified systems. They had all the overhead collapse. So the EBITDA would go up. and the multiple. So they would double their money essentially on paper, on the balance sheet, the second that they closed that deal. And those dynamics may not be quite as significant for an agency, but there still is a multiple factor there, especially if you have some amount of scale. It doesn't have to be a lot. So a lot of opportunity. The thing I want to talk about is your perspective on the market right now. So you talked about some of the factors that make this interesting. The pushback that we might get on this is, well, everybody thinks we're going into a recession. Interest rates are crazy right now. What is your perspective on how to make deals happen in this kind of climate and where things are going, just so everyone can wrap their head around how to think about this given the context?
Yeah, that's a really good question. And when I think about the market environment, especially in the agency vertical, candidly, it doesn't really concern me that much. And I'll give you a couple reasons why. I mean, I think the rate environment especially is not really a major factor, in my opinion, in slowing down deal flow. Now, maybe for really big mega deals, it could have a bigger impact. But if you think about, I'll zoom out a little bit. If you think about something like commercial real estate, right? So I've also done a fair amount of commercial real estate investing. I bought apartment buildings and shopping centers and all kinds of stuff. And an average apartment building might trade at what's called a 5% cap rate, right? So that's a fancy way of saying it trades at like a 5% yield on the purchase price. So if you have an apartment building that's throwing off $1 million a year of cash, right? That apartment building at a 5% cap rate, which is roughly where prices were before rates went up. Now maybe they're at a 6 cap, something like that. But just to make the math easy, a 5% cap rate on $1 million purchase of an apartment building will be that apartment building will sell for about $20 million, right? And the math on that is just $1 million divided by 5% equals $20 million purchase price. And the other way around is if you buy something for 20 million and you generate $1 million a year, that's a 5% yield on your purchase price, which is how that number gets calculated. So that's effectively 20 times EBITDA, right? Or if you're looking at it from an operational business standpoint, that asset, and you'll often have 70, 80% leverage on that, right? So those purchases are highly interest rate sensitive. If you're buying something at 20 times and you're putting, let's say 16 times leverage on it or whatever the math is, that a small uptick in interest rates is going to blow out that model entirely, right? If you're buying an agency, which it depends on the size, but let's say an agency that's making $1 million a year of profit or of EBITDA, to use the fancy term for it. If you have an agency doing $1 million a year of EBITDA, that business might trade at a 5x multiple. It might trade at a 4x. Maybe it could trade at a 6x if they hired Parakeeto and they had super like dialed in, metrics or whatever. But let's just say 5x for the sake of this example. It's a $5 million business. That's 5 times, right? So you can buy $1 million earning stream for $5 million if you're buying an agency, or you could buy $1 million earning stream for $20 million if you're buying an apartment, right? Which is crazy. But that business purchase is going to be much less interest rate sensitive, because even if you're putting, usually the maximum amount of debt you can put on a business purchase is about 3 times the EBITDA of the business. So in that case, you could put $3 million of debt on that business. Now, if you got an SBA loan, maybe it could be higher than that, but we won't get into some of those nuances. But 3 times the EBITDA, you could get $3 million bucks. It's just not going to have that big of an impact. Yes, it'll be more expensive, but it's not going to blow out the purchase price entirely if rates go from 5 to 10%, right? Which is basically what they did for most business loans in the last 2 years. So businesses, agencies are less rate sensitive, but the real factor that makes them even less sensitive to interest rates is not even the fact that the purchase multiples as a percentage of enterprise value are much lower and the leverage is much lower. It's really a lot of the more creative deal structures, you don't even need any leverage to do, right? So if I have an agency and I'm going to go out and bolt on somebody's agency that's making 300 or 400 grand a year and they want to shut it down and they just looking for a home for their customers and a way to get paid a little bit at something, that's a great scenario where it's like, okay, let's say I say I'll pay them 10% of revenue of the book of business, or even 20% of revenue of their book of business. From a buyer standpoint, interest rates have no impact on that, right? Interest rates could be 0%, they could be 100%. I'm paying them 20% of revenue, right? And if revenue goes to 0, I'm paying them nothing. And if revenue grows off of those customers, then I'm paying them even more. But I'm pricing it in a way where I know if I'm paying them 15% of revenue, my margin should be 20%. And then I'm actually making money day one. And you want to make it a variable amount, right? So instead of saying, hey, I'm going to pay you 10 grand a month for the next 3 years, right? I'm going to pay you 10% of revenue for the next 3 years. That's a much less risky way of doing that. So that purchase example is completely insensitive to rates. Now, it may not be insensitive to other factors, but even if the economy, if there's a substantial slowdown in the economy, there's a recession, that business purchase underperforms, the buyer is still hedged, right? Because they're buying it as a percentage of revenue, and the seller is still in the same boat as if they hadn't sold it, because the business was going to decline either way. So neither party is uniquely affected by the recession in a way that it would impact their execution of the deal, if that makes sense. So long-winded answer, and maybe I didn't cover all of it, but that's my perspective.
Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. And with that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. No, it does. It's exactly kind of what I had in mind coming into this. And the truth of the matter is, and for those listening, I'm sorry if this is the first time you're hearing this, but in agencies, it is uncommon for there to be all cash deals that are, leveraged. Like most of the M&A action that's happening, the vast majority of the value of the business that's being transferred is being done in seller financing, is being done in company stock, it's mergers, it's profit sharing, it's combinations of all of these things. Very rarely are you going to see somebody sell their business at 6x, all cash up front, no earn out, no strings
Almost
attached.
never.
It pretty much doesn't have, it's uncommon anywhere, but especially in professional services. And I think the reason for that is, and correct me if you have a different perspective on this, but there's just a higher risk profile to basically an asset-free company,
Exactly.
and that's the reason that you pay 6 times multiple for that versus a 20 times multiple on real estate, which is like the blue chip stock of blue chip stocks as it relates to holding value and over time making sense. So that is part of the reason why deal structures typically are not going to be so cash forward, because there typically is going to be some kind of transition period, and there's going to be a lot more de-risked kind of terms built into that structure.
You're totally right, and that further reduces the interest rate impact, right? So it's like if you're getting 20% of the deal or 30% of the deal seller financing, and 15 or 20% of the deals rolled equity, and suddenly the cash at close is like 50% or even lower than that, right? I mean, it depends again on how much equity they're rolling and what the strategy is going forward. But is there an earnout, right? That could shrink it even further. In a lot of those cases, there's tons of what the industry term is just structure or deal structure, which basically means, another way to phrase it is deferred compensation, right? So the business might have a $2 million valuation, but most sellers aren't getting $2 million at the closing table. They might be getting 750 grand or $1 million or $1.2 million, and then the rest is paid over time as they stick around and as the business performs and all of that. Now, to come back to your question from a minute ago of what do I think the big macro impacts are in the agency space, in a weird way, I don't think a lot of the macro factors, rates, recession, et cetera, in my mind, really meaningfully slow down M&A activity in the agency sector. To me, one of the big variables, and I'm actually curious what your perspective on this is too, is AI. To me, that's actually much more of a dynamic as I think about what's going to really impact agency valuations, is how is AI going to shape things, right? Is it going to be something that mostly just enhances margin, and or is it something that's going to create a massive pricing kind of race to the bottom, where folks where retainer rates come down substantially, and over time revenue shrinks dramatically across industry, right? Or it may hit certain pieces of the industry harder than others, right? Maybe programmatic advertising and paid media gets hit a lot harder than SEO, right? That's conjecture. That's not a stance that I have necessarily, but to me, AI is actually a much bigger variable, creating uncertainty in agency valuations than the macro factors that are happening right now.
Yeah. And I think where you see that show up in the industry is that so much more of the M&A that's happening right now is happening within a thesis, within a very clear, deliberate thesis of what we're trying to accomplish. Perhaps we have a company that has leveraged AI. They have a wedge that's now been built into their business with that. And so there is this kind of strategic opportunity to start rolling things into that. But the just kind of greenfield M&A for the purpose of just doing financial arbitrage is maybe a little less common right now. At least that's kind of what we're seeing.
Yeah, I think that's definitely right. And it's just something it's something to be thoughtful of, right? I mean, it's not going to be an overnight impact, but it already is impacting the industry meaningfully, and it's going to continue to have a pretty meaningful impact. And so thinking through whether that erodes things like revenue and EBITDA over the medium term is a really important consideration as not only just as an agency owner, but also if you're buying an agency. You don't want to buy a business and have it be worth $5 million and then it's worth $2 million 3 years later because the AI shrunk the potential billables by 40% or whatever, 60% or whatever the math is.
Yeah, 100%. So that kind of leads perfectly into my last couple sets of questions, which is you've been doing this for a decade. You've looked at lots of service-based businesses. You've also looked at lots of other kinds of businesses. And more importantly, unlike perhaps maybe some people that are more on the brokerage side, you've had to actually sleep in the bed that you've made several times in the past with
Yeah.
regards to integration, seeing that deal through, rolling things in. In particular, I'm thinking about Fresh, where it looks like there was a lot of bolt-ons that happened there. So talk to me about what you're looking for when you're acquiring a business beyond just the kind of standard stuff that's always on the checklist, like, how they recurring, like how necessary is the founder? Do they hold on to their customers? They have legal contracts, like, okay, all the basics that everybody knows about. What are the things that now that you've actually been in the game for a while, you're looking for that might not have been that intuitive at the start?
Yeah. So really good question. And my answer may be a little bit different than you're expecting, but I'll give you my honest assessment, which is one of the biggest things that's changed for me the more deals that I do is candidly I look for deals that are bigger, right? And for a lot of reasons, right? So that might be sort of obvious and non interesting, but to me it's actually a really important marker for a lot of things. So why bigger deals? One of the biggest reasons is just bigger deals are easier, right? Independent of the fact that you can make more money on a bigger deal, in most cases, a bigger deal has, if a company has, I'll give you a couple illustrations of this. If a company has, let's say, $3 million of EBITDA, right? And I'm buying that business. If I buy a business with $3 million of EBITDA and it has no management at all, right? I can go, let's say I have to go hire a president to run that company. If I go hire somebody who's like a rock star and I pay him 300 grand a year, right? Or maybe I pay him 200 plus some incentives and performance, whatever. That's 10% of my EBITDA. I still have $2.7 million left over. Maybe I invest in some of that in growth and scaling and, more paid media, building out a new office in, another city or whatever. If I buy a business that has 500K of profit, right? And I need to go hire that awesome executive to come and run it. If I'm paying him 300K, that's 60% of my EBITDA, right? So I have 200K total left over. So I really can't even afford that person, right? Especially if I have debt on the purchase. Like there's no way I can afford that person. And I also don't have anything left over for growth. So maybe best case scenario, I can hire somebody for 100K, right? So am I getting a candidate that's lower caliber and I still only have 400K in total to invest in growth initiatives and new projects and all those other things. So bigger businesses are easier to run and they're easier to grow in a lot of cases because you have more resources, right? You can invest more dollars across more initiatives or go deeper into initiatives that are working versus if your marketing budget's 30 grand because your EBITDA is 300 and you don't have a lot of cash to invest in stuff, you're just not going to be able to move the needle as much as somebody whose marketing budget's $500,000, right? So to me, bigger is the more deals I do, the more I look for big companies because it's a really good hallmark of a lot of the other stuff that I care about, right? Which at the end of the day for me, I mean, I'm the deal guy. So, I mean, I have a business partner who he's basically what the private equity term for it would be like an operating partner or the director of portfolio operations for our portfolio. And he's definitely more, you guys would probably, I may have even introduced you guys, honestly. I think maybe I did, but he's super smart, very systems oriented. He really leads the charge on a lot of the integration stuff. So I'm not dealing with necessarily integration, though that is a challenge. Really where I come back in is like, hey, if this business is struggling to perform, right, then I got to figure out how we fix it. which I've dealt with on numerous occasions. But to me, size cures a lot of those things. Doesn't cure everything, but it's just a great indicator of it's usually easier to run. It's easier to finance too. So the bigger the deal is, they're like the universe of potential capital, both lenders and debt capital, and also equity or investors who want to put dollars in. Both of those universes are bigger the bigger you go in a weird way. And so the challenge with bigger deals is they're more competitive, but the upside is that they're easier and you make more money, and they're easier to finance, they're easier to run, they're easier to own. And so to me, that's the biggest lesson I've learned is I continue to ratchet up the deal size. When I look back at my worst deals, the deals that sucked up the most bandwidth for the least amount of return, they were often the smallest. It's like they negatively compound together because it's smaller. There's not as many people. There's not as many resources. The problems are harder to solve, and it's like a death spiral. Whereas bigger companies are like a flywheel, right? Of like more resources, more opportunity, more growth. And so I really skew towards bigger deals generally. The more I've gotten my butt kicked on small deals, especially, right? So that's my I guess one of my biggest learnings from being in the trenches.
It makes perfect sense. It's funny because I worked on my first acquisition this year with my wife, and that was our biggest takeaway as well, which was next time we buy a company, we're going to buy a much bigger company. For all the reasons that you mentioned, like getting financing was a huge pain, dealing with directly with the owners, frankly, was like really challenging because they hadn't run a big business, so they just weren't that sophisticated when it came to this. And
Yep.
so their expectations about purchase price acquisition terms were completely unrealistic, but they didn't have the resources to be advised by people that could talk some sense into them. Like
Yep.
everything was more challenging. And then you get in there and you're constrained on resources. There's a lot of things that are not established that you have to build for the first time. So there's a lot of opportunity, but it was a lot of work and unfortunately a lot more blocking and tackling on things that were tactical as opposed to like attacking the strategic levers that we saw when we first evaluated the deal that we're still
Yep.
now trying to get to after having to do a year of blocking and tackling just to kind of stabilize this thing.
Very, very common experience. So, and
Yeah.
I've been there for sure. So I get it.
So, okay. Now, here's the thing is we talked at the beginning of the show about, hey, the opportunity is there's a lot of solopreneurs. And now we're talking about, hey, but also if you can get after really, really big deals, that's a good thing. And one of the mental blocks that maybe some people listening is like, I can't acquire a business that's bigger than mine. But that's of course not true. Let's talk through that. Like, how do you think about, you see an opportunity to go and acquire or merge with a business that's much larger than you are. How do we think about approaching that kind of an opportunity?
Very interesting question. And I do think, so that's the term you'll hear for that if you want to read up about it is called minnow swallows whale. That's often and there's tons of deals historically when you look at that, you can kind of read about some good and bad case studies of that happening. But before we jump into that, I do like something you said a second ago, I want to hit on because I think it's really important, which is the distinction between an add-on acquisition and a platform acquisition. Those are terms you'll hear in the private equity world, especially. But for me, when I say bigger deals are better, I think that holds true across the board. But for me, it especially holds true when I'm looking at a new platform. So when I'm like entering a new market, say, hey, I'm buying a manufacturing business that's in a niche. I don't have any companies in that space. It needs to be big enough to make it make sense. Once you're in a space, and this is if you own an existing business, smaller deals are still more of a headache than bigger deals, but they can get a lot more interesting if you have good operating infrastructure, right? So if you have a team, you have the resources where you can just plug and play these acquisitions. The case study you shared earlier about your friend in the pharmacy space, right? They have the whole infrastructure developed and they're just buying them at 3x. Their company trades at 6x. It's just instantly creating huge amounts of equity value by rolling these companies up. So I do think there's merit to, if you have a well-run and established existing platform business, i.e. your agency is capable of adding on agencies, I think it's totally fine and feasible to go look at doing smaller deals and adding them on. I think if you're saying, hey, let's say I just sold my agency and I want to get into a new business, don't go buy a business that's making a couple $100,000. Go buy a business that's making more than that, right? So having said that, there's a lot of elements that could go into thinking about doing a minnow swallows whale type transaction, right? So a lot of it depends on where I guess not only to me, this will zoom out a little bit, but it'll make sense in a second. When I think about deal structure, one of the big things I'm always trying to do, especially in the front end of a deal, is really deeply understand what is the other party wanting to accomplish, right? What are their goals, needs, desires? Where are they trying to take things? And so if you have a really good understanding of that, that ultimately, in my opinion, informs the rest of the deal structure. And so the way to pull off crazy, ridiculous deals in most cases is you have to really deeply understand what the other party wants to do. And then you craft a deal structure that fits that. And so if you're going to do a minnow swallows whale deal where you're going to buy a company that's bigger than yours, the a lot of it's going to depend on that company. What are they trying to solve for, right? Do they want to, and one of the big questions, one of the big first questions you're going to have to figure out is, do they want to stick around or do they want to leave? And based on the fork in the road there, that's going to determine how you position, how you structure, how you approach that deal, right? Because those could be very different strategies and avenues where, depending on their interest level and involvement going forward, you structure the deal very differently, right? But there's lots of levers you can use for that, right? You can use, one of the most interesting, I'll give you just a anecdotal example, right? Is like, even if you do a deal where you don't own, let's say you merge a company that's 3 times larger than yours, right? So let's say my company's worth $1 million, yours is worth 3. We merge into a $4 million company. We could structure it in a way where you say, hey, I don't want to be as active, but I want to keep some of my like economic exposure, whatever. You could structure it where the merging company gets non-voting stock and you have voting stock. So even if you only own, let's say, 25% of the equity, you own 100% of the voting rights, right? So in that scenario, you would control the entire enterprise, even though you would have a smaller economic stake in it, right? But there's lots of other ways you could phase out or earn out their equity over time. You could use what's called a baseline structure, which is basically if you said, hey, same idea, I have $1 million agency, you have a $3 million agency, let's roll them together. What we're going to do is we're going to create a structure where your $3 million equity value is protected or locked in with what's called a liquidity preference. And basically, when we sell this merged co, you're going to get $3 million, right? And maybe you also get some upside in the whole merged co. So maybe it's $3 million plus 20% of the additional value of the company or whatever. I'm just making these numbers up, obviously. But in that scenario, right, you basically could take over their entire business, and now you have to figure out how to eventually get them $3 million when you sell it, but you don't have to come up with $3 million at the closing table, right? And now you control and own that business. Then you go bolt on a bunch of other companies, and maybe that $3 million valuation was at a 4x multiple. You go sell the whole big portfolio for a 6x in 2 years, and you keep the delta between what it was worth when it merged in and what it's worth now. So couple random illustrations of how to think about potentially doing a deal like that, but there's a lot more to it, but hopefully that gives you at least a few ideas to think through as you contemplate just some of the nuances of doing crazy creative deals.
Well, Matt, I, fortunately or unfortunately for our audience, I could talk to you about this stuff for hours. Unfortunately, we don't have time for that. But the next time I'm in Nashville, I will be looking you up. And I think
Yes,
this
let's
would
get
be
coffee.
a fun conversation to have. Yeah. But with that in mind, I think it's important that we make it clear why an extremely busy person like yourself carves out time to come on a podcast like this and to call a spade a spade. The reason is you're in the business of acquiring and partnering with other businesses. And there's a lot of businesses listening to this. So I want to give you just very clearly a platform to talk about who might want to reach out to you if partnering with you is something that sounds interesting.
Awesome. I appreciate that, Marcel. Thank you so much. Yeah. So the reason I do content and podcasts and so forth is exactly that. I want to connect with business owners. I want to find opportunities for me to partner or invest in companies. And the easiest way I aggregate that is basically I have a weekly newsletter called the Deal Insider, the Deal Mastery Insider. It's available at my website, mattbodnar.com. Anybody can sign up for it. It's totally free. And I talk about deals and M&A and case studies and structure and all kinds of stuff. And I also personally respond to every email on there. So if you sign up for the newsletter, you shoot me an email. It's going to be me replying. And I talk to people about all kinds of crazy random stuff, see all kinds of interesting deals come through there. And I often look at, either partnering or investing or doing something with some of the folks that come through there. So that's the easiest way to find me and interact with me is through my newsletter. And that's just at mattbodnar.com. There's a big button that says newsletter, and you can check it out and hit me up.
Awesome. So with that, we're going to leave links to Matt's website, the newsletter, as well as Matt's podcast in the show notes and his LinkedIn. And, I was on your website earlier. It's very clear on the website what kind of stuff you're looking for. So if you're interested in selling your business and or partnering with Matt, then you can go read up on what that looks like and reach out. And with that, Matt, I really enjoyed our conversation. I appreciate you making time for us today. So thanks for being on the show.
Awesome. Thanks so much, Marcel. I really appreciate it. Awesome conversation. And I look forward to doing another one or seeing you soon in Nashville.
Sounds great. And thanks to everyone that tuned in. Leave us a comment wherever you're listening to this and let us know what you learned. And we'll look forward to seeing you in the next episode. Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.